All right, this is stock market update, February 2022. I made some predictions last month about this coming quarter, and I was right about some things, and I was wrong about some things. Number one, I thought that Christmas numbers were going to really pull the market down, along with the rising interest rate, and that did not happen. Well, it did happen. The market did drop by quite a bit um, in the month of January, but it recovered fairly quickly. Currently, 82% of the stocks in our basket are above their 200-day and 77 above their 50-day. Currently, that is a record. Now, that's not saying much, only because I've only had this metric here for maybe the last 4, 5, 6 months or something. So really don't know what that means, but as of right now, it is the highest that we have seen it. Let's take a look at the sectors and see where they are and what they're doing. Um, Basic sector did lose a little bit this past month. Um, Probably the worst performing sector currently at only 57 above their 50 day and 71% above their 50. To me, that means that the current increase in stock prices is very recent, but the historical trend line is still downward sloping for these particular sectors. Um, oh, what happened? All right, telecoms slightly up for the month, 80% above their 200, 80% above their 50. I'm going to call this a consumer sector, simply because the communications, telecoms is mostly about cell phones, internet, cable. Um, of course, businesses also pay for those things, but for the most part, this is going to be consumer driven. So decent sector. Consumer cyclicals. Obviously, over the past month, 84% above their 50-day means that something happened with those Christmas numbers for these stock prices to rise as much as they have. But again, historically, over the last year, these companies are still way down, right? But again, obviously, the Christmas numbers were good enough, and inflation has not hit this sector as hard as I thought maybe it will have, or will had, but didn't. So that's really interesting. Continue to see kind of where that goes. Consumer defensive, consumer durables. Again, another consumer play, right? This is people buying soups and forks and whatnot, right? So 89% above the 200-day, 84% above their 50-day, and slightly up over the last month. Energy, 100%. It doesn't get much higher than that. I'm going to be really curious to see which energy companies did not perform well this past month. Those are the companies that I want to stay away from. The companies that performed well means that they're doing at least average, right? Companies that did not perform well are doing horrible, because for 100%, because of all the companies above their 250-day means that it's really hard for you to lose money right now if you're in the energy sector. And if you look at 3% increase almost over last month is huge. That's crazy. And again, it goes back to the consumer too, right? Because energy is all about consumer spending. Financials, banks, slightly up over the past month, 85 over their 200, 85 over their 50. Decent sector, definitely top three, top five. Um, Again, this is a consumer thing. Interest rate hikes mean more money for banks, but banks also are dependent upon persons having money to deposit into the account. spend money on credit cards, sign for loans, that thing. So we have to have a decent economy for that to happen. And it looks like so far so good. As long as companies can increase prices and consumers have the money to pay them, we'll be in good shape. Health sector, 80% above 200, 80% above 50. I mean, at this point, it looks like that's par for the course, um, unless you're basic materials or industrials. Industrials is actually opposite of everyone else. 86% above the 200, only 43% above 50, meaning that companies are doing much better now than what they have done in the past, but more recently have failed a lot. And the question becomes why? Why have these industrial names fallen so much when they've done so well? It's really interesting. When you talk about industrials, you talk about basic materials, these are all the things that we need to build and produce. And so for the basic material sector to not perform well means that the economy is not really growing. It's not really producing. It's just a lot of cash spending with a lot of free cash that's floating around. With these industrials, it's kind of the same thing, right? These are the products that make everything move. And they were performing really well, and all of a sudden they just, you know, fail like crazy. So it tells me that again, you know, the market being as high as it is right now is still all about free cash, easy money, and interest rates are going up to try to deal with that. I imagine as we go through this year, the more there talks about more hikes, means that we're going to see more stock market falls for those growth companies that we're used to seeing skyrocket so high when there's free flowing money. All right, the real estate sector. Definitely not the best performing, and it has been, which is interesting. Only 69% above is 200-day, 31% above 50-day, meaning that just overall the real estate sector is falling, and this has everything to do not only with interest rate hikes, because for real estate companies, for the most part, they're borrowing money to buy property and then sell that property at an interest rate. So if I've already contracted with someone at 4% and all of a sudden interest rate goes up to 6%, let's say, well, technically I'm losing 2% whenever the rate hike goes up. I'm losing because I will have made 6% if I waited to contract with this person, but I didn't. I contracted at 4%. Same thing happens when they borrow money. When you were able to borrow at 3%, now you're having to borrow at 4%, which means your profit margins are slimmer. The other thing is you have to have a consumer with the money to purchase the real estate. You have to have the business with the money to purchase the real estate. You have to have growth. And so when I see, again, sectors like basic materials and real estate falling, it tells me that we're not really producing more stuff. We're just spending more cash. And at some point, that cash is going to run out. Interest rates are going to continue to rise, making borrowing harder and harder to do. And at some point, the S has hit the fan. I don't know what that means, when it'll happen, but clearly that's what we're seeing right now. Technology, we all know the story. Interest rate hikes, technology gets hit hard. But again, too, this is a consumer play, right? When consumers have cash, they spend it on technology. And so it's interesting that we have these consumer cyclicals, we have these consumer durables that are performing so well. We have these telecoms that are performing so well. But for whatever reason, the tech companies that's selling, well, not selling, but making the technology that we're buying from these retail stores are not doing great. And of course, the conversation about chip shortages and things of that nature has been the story for quite some time. I wonder what happens when we finally do get chips back online. Are these tech companies going to have just a field day, kind of like what we saw in energy, where they have all these electronics in inventory just sitting there waiting on the chips? And so when they finally do get the chips, they'll be able to sell the inventory without having to, make more things and increasing their profit margins. That'll be really interesting to see. I don't quite understand why there's still a chip shortage, um, or how long that's going to last, but at some point it has to correct itself. And then utilities, again, really just not necessarily outshining, but um, performing very well. Again, for a market that obviously doesn't see any problems in the future of persons paying their utility bills. Whether or not utility bills will increase because of new housing or new activity, bigger families, I don't think that's even in the conversation at the moment. But obviously, when you see the utility sector perform well, no one is really um, worried about where we are in the economy. The other thing too is that the utility sector is something of a defensive play, right? Because these are the companies where you know exactly how much money they're going to make. You know exactly what you can expect from them, and so maybe money is moving into these utility companies because people are a bit unsure about the market. All right, let's take a look at some individual names here. Um, Something's not right. Let's see what could be going on. 1021, no, that's correct. I don't see any MVPs. Okay, that's better. Let's do a quick sort. Alright, so we'll start off in basic materials. AEM, we've seen them over and over again. Sector MVP, but one of the worst performers. NEM, um, second in line as far as sector MVP. Again, not performing the best. CF has been a sector leader as far as returns go for quite some time. So definitely something to keep our eye on. And Southern Copper is where we are. Not the worst performer, but definitely not the best. In telecommunications, AT&T and OMC are the sector MVPs there. Looks like everyone is about average, with the exception of AT&T, which has just performed horribly over the last year at least. Everyone else is about the same at about 1%. And in consumer cyclical, we see Best Buy, and I'm curious. I mean, like I said, this sector performed so well, but we see over the last month there's a bunch of negatives here. PKG, which is packaging, I believe, um, was up 8%. Maybe that is what carried the sector. I mean, that is hard to believe that that one company is what really put the sector over. But as you can see here, I wasn't completely wrong. Obviously, either interest rates or Christmas numbers really hurt these companies in the cyclical sector. But we do have this one outlier here at 8%. Best Buy sector MVP, but not anywhere near best performing. That goes to IPG and GPC. We're currently in IP, which is also a packaging company. So really curious to see what the differences are right now between IP and PKG. All right, consumer defensive. Again, this was another sector that performed really well as of late, and it looks like the MVP is pretty much spread out here. Philip Morris is definitely the sector MVP, no doubt, but we got three, two, 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 and one spread across the top five companies here. Philip Morris, I say sector average as far as returns. Looks like the sector leader goes to ADM. Don't know a whole lot about them, but I've seen them quite a bit. So that's interesting there. And then looking at the last month, ADM 13%, and yeah, I mean 6%, 3%, 1%. So this sector has really done well over the last month. We're currently in Campbell's Soup, which is down here at the bottom. And you can see not performing as well as the rest of the sector, but not the, well, almost the worst performer. Almost, yeah. No, yeah, the worst performer. At least second to the worst. So, not a great position to be in, but not a bad position overall, honestly. Okay, so Valero sector MVP. That's where we are. I'm going to call this sector average as far as the return goes. And then we have ELG second up. Now we do have to take a look at possibly replacing Valero. So a couple of these companies we're definitely going to want to look at. Valero, ELG, looks like IMO are sector leaders. And then VLO, ELG, TRP, OKE. Yeah, I don't think we need to bother with those, but ELG and IMO will definitely take a look at for sure. All right, financial services. These are all the banks. Again, sector performing really well. Blackstone, again, sector MVP, but really spread out amongst the sector here, meaning that in any given month, any one of these companies can be best performing. It's very possible that next month we'll have Blackstone at 3, and someone else down here at 1, or Blackstone could be at 5. Who knows? But point is it's kind of a toss up. Blackstone is the sector leader though at 6% per month, which is crazy, blowing out everyone else. But again, the sector itself is doing fairly well. Everyone is at about 3%. We're currently in RF, about sector average there. Lots of financial companies, all of them at roughly 2-3% a month. And then healthcare, as you can see, very slim pickings. A lot of that has to do with the dividend. And Merck, sector MVP, but not anywhere near sector leader. That goes to Pfizer, who is hands down the COVID winner this year at almost 4% a month, followed by CVS, which is again a big COVID winner. Relative to the rest of these guys, CVS was able to stay open during all the shutdowns, yada yada yada. All right, so industrials is a sector that we talked about. Again, kind of slim pickings here, not a whole lot to choose from. EMR is the sector MVP, and it's like IRM, Paychex, and Raytheon are sector leaders. IRM though, I say about the same. I've always liked Paychex. Always keep them in my mind. Looking just over the last month, it looks like most of these guys were down almost 10%. IEP and EMR are going to be the difference, and then of course Raytheon was up almost 8%. So definitely something going on in industrials that I'm not aware of, but again, this has a lot to do with either growth, or maybe these guys are having some sort of supply chain issues. Haven't run across that in Raytheon, so I'm not sure what's going on with the rest of these guys. And Paychex, is all about human resources, all about jobs. And so why they dropped 12%, I don't know. Maybe it's the story about people leaving jobs and quitting. Maybe that's what's going on. But either way, industrials not performing very well. All right, real estate. We know that real estate has taken a fairly big dive here over the last month at least. MPW where we are, sector MVP, but definitely not the sector leader. That goes to SPG, which I believe is residential real estate. I may be wrong about that. It might be commercial, but I think it's residential real estate, and so that's very interesting to see that because again, we're talking about consumer spending. If there's cash out there for consumers to spend, they will spend it, and maybe SPG is really taking advantage of that right now. All right, technology we talked about. Again, really slim pickings. I was speaking to someone just yesterday about Corning. They raised their dividend 13%, which is nice. You like it when the company pays their stockholders more money. But even with that raise, the dividend is only 2.55%, and our cutoff is 2%. The company has to pay at least 2%, and so the discussion surrounded, what happens if the stock prices continue to rise and dividends don't rise with it. At some point, we won't have any technology companies to choose from at all, and then we'll be looking at corporate bonds. Whenever equity prices rise, dividend rates fall, but bonds usually fall and bond rates rise. And so we'll be looking at maybe getting into some corporate bonds there. So yeah, GLW, Corning, sector MVP. I'll say roughly sector average as far as return goes. Hewlett Packard though really blowing the rest of the guys out of the water at almost 4% a month. It's pretty good. Our utilities, ETR, sector MVP. That's where we are, right at 1.5%, about sector average, and the rest of these guys are kind of spread out. But ETR still sector MVP for sure. And we got a bunch of utility companies here. Xcel Energy down here at the bottom at roughly 1%, so a little less than average. But again, utility sector performing really well. Let's take a look now at the portfolio results. I am curious. So this is as of July 2020. The down standard portfolio down moves, and then we got M score up here performing the best, which is interesting. That M score portfolio is companies that have not only a lot of cash on the books, but they also have very low debt. And so I think maybe what's happening is money is going into companies that are not necessarily defensive, because that'll be your beta companies. Those companies that perform well when the stock market is doing poorly, right? So money isn't going into those companies, but it is going into companies that are safer because they do have the cash, right? If you're dealing with a company, primarily a growth company, that is using all of their cash to put back into the business to grow the company more and more and more and more, they're not going to have a lot of cash on hand, right? Because it's always being spent on capital improvements, assets, things of that nature. And a lot of times they'll have a lot of debt as well, right? But when you're dealing with a company that has a bunch of cash on hand, it's because they're making money, but they also don't really have a lot of room to grow, because if they did, then they would spend the money to grow, right? Or potentially buy another company to continue to grow. So if they have a lot of cash, it's it's kind of a safe bet, right? Just meaning that when you purchase the stock, a larger portion of that stock is going to be actual cash. So if something happens, you know for sure that you're going to be paid out because the company has cash to pay out, right? So that tells me that again, we're in a position where people aren't sure, right, of kind of where we are. We're definitely not going after those growth names, right? But we're not so scared that money is going into beta names. Money is going into safer companies, though. That's why we see stuff like utility sector and the bank sector work so well right now. Let's look at the last 12 months. And again, we've seen this month after month up moves, and then standard deviation, and then we see some beta stuff here at the top as well. And so again, this is about defense, but up moves is not really defensive, which is the weird thing, you know. But these are the more recent performers here that we're looking at, right? So up moves is aggressive, but not as aggressive as something like a return or alpha. Okay, and then the standard deviation, that's all about companies that don't move around a whole lot. So when we see these big drops in the market, these companies are not losing as much money. But at the same time, when the market is going up really, really fast, these companies are not making as much money either. Um, let's take a look at now the worst performing, because I think that tells us just as much as the best performing. Um, yeah, so dividend, beta, dividends. Yeah, so anything with a high dividend usually means that the stock price is coming down, right? But you do get rewarded with that larger dividend percentage. But again, if you were to invest purely for the dividend, you'll lose a lot of money according to this over the last 12 months anyway. Let's take a look now since 2020, and looks like beta, beta, and a couple returns is the worst place you'll want to be um, from June 2020 currently, or I think it's actually July, but either way, it's 2020. Um, yeah, these are the worst portfolios to be in. Betas, and then there's some returns in there. So again, that kind of goes back to when we see beta here, right? In the last 12 months, we know that that's false because beta is in the worst performing portfolios in the other areas, and so that's why we can completely just ignore these beta portfolios that we see. And so we're looking more at like the up moves, the standard deviation, and of course, a longer term trend is looking at the down moves and the M score, because I think with the M score we're kind of seeing that across the board here. Um, Not really, not recently. Looks like that's more it's more long term. Let's go back to see the worst. I see there's only one M score there, and look at the worst here, and one there was kind of far down. So um, again, you know, that tells me that even though we do see M score here kind of at the top of the list, um, it's not part of the worst performing portfolios. So again, I think that there is something to this movement into these M score companies. Let's take a look at those portfolios and see what's in there. So, all right, so this is the pure M score play. And so we see Regions Financials where we at. That's top dog, which is I really didn't expect. Best Buy, OMC, NEM, we saw them. Philip Morris, we saw them. Hewlett Packard saw them. MPW, that's where we are. EOG, we saw them. CAH, didn't expect that. IEP, kind of saw that. And then PPL is just I think it's a random utility, honestly. You can probably put anything in there, and it'll work just as fine because, yeah, current price 29, purchase price 26. So it's gone up a bit, but I don't think there's a big deal there. Let's look at now the M score, standard deviation. All right, so same thing. Regions Financial at the very top. Didn't expect that, but it's good to see. It's kind of, it's where we are. Best Buy, OMC, NEM again, Philip Morris again, Hewlett Packard, MPW, EOG, CH. So pretty much identical. No, is identical. It's the exact same portfolio as the M score. So that's interesting. So maybe the standard. Let's see what the standard deviation has. Now I'm curious. Let's see what's in that standard deviation portfolio. I want to see how close it is to the M score, because maybe what we're saying here is that the M score portfolio has a lower standard deviation just because of all the cash. So let's take a look. All right, so here's the standard deviation portfolio. Tullis, Royal. Okay, no, it's completely different. Completely different. Yeah, completely different. The only thing that's similar is the NEM, and that's it. I think maybe GPC too. That's it. So, um, yeah. So M score is really a thing. Um, let's take a look. Let's see. So again, we're just kind of looking at colors here. Dark green is good. Dark red is bad. And uh-oh, skip some. All right. And when you see the dark green and dark red together, that means that that portfolio is just all over the place. It's losing a lot of money one month and making money the next month. That's going to give you a high standard deviation, um, large volatility, and typically those are not the best performing portfolios. What we want is something that's, yellowish to greenish, not a lot of red. But of course, that's going to happen. And so we're getting into the darker reds now. Kind of lighten up there. That one looks decent. Not a lot of red there. What's this? Beta return alpha. Okay, not bad. Let's see. Yeah, it's really hard to tell sometimes by the colors, but I mean, when you look up here, beta return down, beta return standard deviation, all that stuff looks really good, and then everything seems to get red around here, um, and it makes sense. The market kind of moves together. What is interesting though is when you have a lot of portfolios losing money, and then you look at the portfolios that didn't lose a lot of money those months, kind of tells you the story of kind of what's happening. See, so the alpha and the return portfolio this particular month performed better because these companies perform well when the market is performing well and everyone else lost money. It's really weird. So again, these are going to be your growth names. And I think the market is kind of going back and forth right now. But I do maintain though that as long as we have um, this the COVID thing still hanging over us, as long as we have interest rate hikes happening, we're going to continually see these growth names and these return portfolios and alpha portfolios not perform very well. Everything is really moving to more of a defensive position. We see the dark greens down here more recently. Um, yeah, alpha down, some more down stuff. M scores, M scores, M scores. So I mean, there you go. I mean, pretty much down to M scores. You can see the green straight across there. That's all M score portfolios. Companies that have a bunch of cash on the books, that's managing their assets really well. That's kind of where you want to be right now. And then, interestingly enough, a lot of this stuff are dividends, which we know by the numbers have not performed very well. But when you're looking at just a color code here, it doesn't look bad, right? I think maybe what's happening is they're performing really well one month and just horribly the next month. So it's just really up and down. And then all of these pure plays are just like, ooh. I mean, look at this dark green, dark red. It's crazy. And these are the up moves. So it's just a lot of volatility. Let's take a look and see. So I didn't check that. I am curious. Let's do let's do this. Let's just see what the highest volatility has been. All right. So, oh wait, wrong one. There we go. All right. So, down standard moves, alpha, alpha. So, all right, there you go. So, the down moves has moved down more than anyone else, and that's not the way that's supposed to work. But that's where we are. All right, let's now take a look at the highest jump. And it makes sense, down moves again, risk. You lose a lot or you make a lot, right? Let's see who's done the best at this. M score, betas, kind of really all over the place, but it does kind of match what we saw with the color codes. We see the M score, the return alpha, the betas, and the dividends kind of at the top, um, where they aren't losing a lot, um, but I don't think they're making a lot either. And yeah, there you go. So M scores again, return alpha, dividend, return. So it's kind of like if you want a larger return, you got to go with the down portfolios, right? But that means that you're gonna lose too, you know. Um, and then if you want to not take risk, um, then maybe you want to go for something like an M score type portfolio. It's really hard to say beta just because beta hasn't. Well, yeah, beta too. More recently, anyway. But again, beta is also, you know, one of the worst performing. Let me just double check that. Yeah, still, it's one of the worst performing. So the M score maybe more for defense. The down looks like it's going to be better for offense, but it is risky, and so we'll be looking at that as we look at possibly replacing Valero, where we do want something with great down moves because we do want that return, but we also want something with a little bit more M score to give us that protection.